Hi, welcome to the introduction. In this video, we review the following concepts. To get things started, let's zoom out and take a view of national economies from up here. In a country, we have the industries producing the goods and services for which there is an economic benefit to the other participants of the economy. The economic benefit is mainly money or something that can be substituted for money. Producers are therefore incentivized to produce goods and services that can be exchanged for money, and a multitude of markets exist that demand products and services. The vacuum cleaner markets for housewives. Business executives needing the latest in cutting-edge technology lest they are outperformed by the competition. Some individuals exchange their labor in a monthly ritual culminating in a day of celebration called payday. Note how money is the common medium of exchange in all of these transactions. It circulates through the economy like blood does through the body. Because money is a substitute for goods and services between participants, we should not be surprised by the fact that this intermediary role led to money itself becoming accepted as an asset. A distinguishing property of assets is that they are expected to produce income for the owner of the asset. Let's explore this idea. The use of an asset by someone other than the owner gives rise to a payment for the right to use the asset. When the asset is property, the person using, or rather staying in, the property will pay the owner rent. This is to compensate the owner for the use of the property. When the asset is money, then the owner lends money to a borrower. The borrower will be required to repay the amount borrowed sometime in the future and will also have to make a use of money payment to the lender. In this case, the use of money fee is called interest. It specifically caters for a situation where money is exchanged between two parties, a borrower and a lender, in return for a fee. From the perspective of a borrower, he or she pays an amount of interest to the lender in return for the use of money borrowed. For example, if Anna buys shoes on her credit card, she will create a balance outstanding on the card and will have to make interest payments on this outstanding balance. This normally happens every month and is the cost to Anna of having borrowed money from the credit card company. From the lender's perspective, he or she receives interest as a return on money lent. For example, if Thomas invests funds at a bank, he's lending money to the bank. Whilst his funds are invested and the bank has use of the funds, he will receive interest income on the amount he's invested. This normally happens once a month. Let's wrap things up and have a look at a scenario where a transaction has been agreed between a borrower and a lender. In particular, we will turn our attention to the different dates on which cash flows occur in this simplified scenario. On the start of a transaction, the borrower will receive an amount of money. We call this amount the principal. Let's fast forward to the end date, or more correctly, the maturity date of the transaction. The borrower will now repay the principal along with interest as a single payment. We'll be referring to this amount as the maturity value.